Good morning, everyone. It is 6 a.m., half an hour before the markets for the open on Thursday, May 30th, almost the end of the month. So we have been waiting for the big report this week, which was the GDP, and we'll see how that is affecting the markets from the TLT. You can see it looks like TLT moved up a little bit, probably due to the GDP report, but we'll see. And let's take a look at our futures first. Let's see what our reaction is. Down, but not significantly in the S&P or NASDAQ. Dow is interesting. So there's a little bit of disagreement or divergence here, or something is affecting the Dow much more so than the S&P and NASDAQ. So we'll want to take a look and see if we can identify what that is. But the S&P is down about a quarter of a percentage point. The NASDAQ is down 0.15 or 15 basis points, but the Dow is down like over 80 basis points. So that's really interesting. This is random, definitely not random in the Dow. So let's take a look at our pre-market levels. We got in the S&P 500, we did baby spike up right at the report and then traded right back down. So market so far is not making much of that GDP report. The Russell 2000 spike up and stayed up, and then the QQQ up, then down, and Dow Jones didn't really do much of anything. That's really interesting. So we have a reaction in the S&P and QQQ, but traded off of the reaction. We have almost no reaction in the Dow Jones, and then we went up and stayed up in the Russell. So a divergence between risk and non-risk. So let's take a look at the actual report and see if we can see what's going on there. So previously we had 1.6 on the GDP. We felt that it would go down to 1.5. It actually went down to 1.3. So that's a softer report. Softer report, but not hugely softer. So we really shouldn't have a spike or too much of a change in expectation that the Fed might lower rates. Softer GDP obviously isn't great for the economy, but it does slightly increase the chances that the Fed will raise rates. And that's probably the reaction you're seeing in this TLT right here. Well, it's a little bit too much. So this is maybe a combination of the GDP and the fact that we gapped down and moved out so hard in the TLT yesterday, just a natural pullback from that. If you're in the TLT trade that I suggested a little while ago, you're in profit. Probably if you're over here by probably 30-40%, and if you're in from here, maybe well over 100%, it's probably time to take profits, because it looks like that we could bounce and retrace, fill this gap, or maybe go up to that EMA 20, EMA 50 region. There's a lot of convergence here on moving averages. Moving averages, we don't usually care too much in Treasury land, but there is a lot. This is also a horizontal now resistance. So we could trace back before moving back down to the channel, which could give us a little bit of relief in the overall market, the S&P 500 and QQQ. So it looks like it's a good time to take that off and then put it back on if we fill that gap or go a little bit higher than that gap. Other than that, so why Dow? So it seems like there's a sentiment that there's risk coming back into the market. Okay, so exactly what I said on the TLT, there could be a little bounce back temporarily right here. So that would give us, that would favor the riskier sectors, the growth sectors. So that might explain why the Dow Jones is flat, but the IWM is up. And initially we went up in the QQQ and the SPY, but we traded off, not completely, but we've undone a lot of it since that report came out. Let's take a look at that Fed Watch tool and see if our percentages have changed. Basically, no one thinks that it's going to happen in June. We might even have a tiny percentage of moving upwards. And then in July, yesterday we were at 10, now we're at 14%. So there is that bounce because of the GDP or because we traded too hard downward yesterday. So that is bringing these levels back up, but really they should collapse down to zero as we get to July 31st. So the trade is still good, or the view that we're going to move down towards the bottom of the channel is still valid. It's just that we might bounce up a little bit on our way there. Let's take a look at VIX. Okay, that's interesting. So overnight, we spiked all the way up to almost to the 15 level, which was what we talked about yesterday. And we got up to the 14.82. So that's pretty close. That's close enough. And we traded off, pulling back down, and we're currently at 14.27. We closed yesterday at 14.27. So exactly the level where we closed yesterday. So it looks like there is a little bit of a bounce back sentiment happening in the market, which means that we can expect to stay within this channel. GDP report wasn't so amazing that we would think that we would break out of this sideways channel that we've been trading in, or at least not today. So us making pullback, at least maybe not today. Hopefully we'll get some volume back into the markets, and then we'll at some point break out of this sideways trading channel. Okay. All right, we took a look at the VIX. We took a look at the GDP. Oh, part of the GDP report is the personal consumption. There you go. Personal consumption expenditures. And this is what the Fed looks at. Okay, so we're probably reacting off of this, and less so the GDP. The previous personal expenditures was 2.5. This is what the Fed looks at in terms of how much are people spending, and that using that as an inflation gauge. Now that's kind of dangerous because people might be spending less because there's less inflation, or they could be spending less because they just are not spending on consumer discretionary items. They're electing not to spend their money because they're not feeling great about the economy. So this could be double-edged sword here. There is quarter on quarter, the GDP did shrink. So this drop in personal expenditures could be because consumers are really feeling it and they're not feeling very confident. Or we could say, hey, if inflation came down a little bit, and that's easing pressure for the consumer. But in any case, the actual 2.0 was less, not hugely less than the 2.2 we conceded, but quite a bit less than the prior number. And that's probably why we're reacting the way we are. Let's take a look if we can see XLY. It's probably not, yeah. So what we want to see is in the retail sector and in the consumer discretionary sector, which we had a bunch of earnings for last night, this morning, and we have more major earnings tomorrow or today after market. So how those earnings come out will be very telling for us. Let's just take a look at what came out already today before market and yesterday. Can I see yesterday? What was yesterday? 29th. And we need the aftermarket. American Eagle. I'm only looking for the retail. Salesforce is not retail, but a whole bunch of retail and consumer discretionary use that for their marketing. So we'll take a look at CRM, AEO. CRM did not do well on their earnings. AEO did not do well. BBY, Pearl, Best Buy did well. Burlington did well. A little bit of a mixed bag so far. Let's take a look at Dollar General, Duluth, Foot Locker, Foot Locker up, Duluth, looks like it down. Dollar General, flat, initially up, then flat. So mostly mixed bag, I would say. Hard to gauge. I don't know the relative market caps on everything that we looked at. So it's hard for me to gauge whether that is strong or weak, but it's very mixed at the very least in that retail space. So depending on how big earnings today after market come out, especially Costco. Costco not coming out today. Oh, there it is, Costco. We've got flipped backwards. Okay, Costco. Dell will be interesting as well, although that is a mix. So Ulta and Costco, Gap, those will Nordstrom, those will be telling, and we'll see. We'll get to a better idea of this personal consumption, whether it is down because people are pinching pennies or down because they're not feeling it as much in the retail space. An interesting thing that happened, by the way, on the GDP is prior we have 1.6, but that's the revised number. If the actual report, the previous GDP report prior was actually 3.4. So that we can see that over here in this trading economics calendar. They show you the previous and the adjusted. Where is it? Today is the 30th. There we go. Previous 3.4. Okay. So then they adjusted it down to 1.6. Okay. So that is really interesting because that's a huge adjustment, which means either someone really goofed up their job or we might be playing some games over here with our numbers. So I'm going to take this GDP report with a grain of salt, and I'm just going to see what the market reaction is. So far, for the overall market, it's very, very muted reaction. And it does not necessarily give us confidence that we're going to break out of the trading range that we've been stuck in. So we'll just patiently wait. The pre-market, 3, 4. Oh, okay. Yeah, we're just running out of space. That's why. Where did we close yesterday? 5 to 6.1, pre-market at 5 to 4.23. So down a tiny bit. We traded off overnight. So actually, looks like we might 325.24 is right at this purple line. Okay, so we'll really want to see how we trade today. Did we not preserve our purple line over here? Let's get that back. That was the line we had yesterday. And let's add the low of yesterday as well. Okay. So we really want to see if we break down during the session today, because if we break down significantly with momentum, if volume finally comes back in, then we will have broken out of this purple line range, and then we'll everything that we've been saying about the higher likelihood if we do break out would be to the downside. Well, it looks like we may possibly get that to the downside today, and then in which case we will go to the MA50. But given how the TLT is reacting and given how VIX is coming down, it looks a little bit more likely that we'll stay within this range today, and we'll have to wait for some other catalyst to bring us out of this range. So it could happen today, but given how the TLT and VIX are reacting, I'm not super confident that it would happen. Right? So we'll stay careful, keep our portfolios neutral until we actually see a movement. We don't want to front run it or anticipate what is going to happen. We just want to respond to what is happening. So in other words, our goal is never to catch a bottom or a top. What we want to do is catch the high conviction area in the middle, like this. And so as a trader, I'm never going to be the guy who catches the very bottom, and I'm never going to be the guy who catches the very top. If I happen to catch the very bottom or very close to it, there's almost a 0% chance that I'm also going to catch the very top or very close to it. However, this middle region right here, I can catch that almost every single time. So this is what we're looking for, that consistency and high conviction, high probability. We shouldn't be trying to catch the bottom. We shouldn't be trying to catch the top. I shouldn't be going, hey, this is going to break and then I'm going to catch this top. It's a great area to short and then catch the perfect bounce off of the MA50. No, that's why we have confirmation bars. That's why we wait for a bounce and then a confirmation, not just we hit the level. Okay. And sometimes we may wait for even more than just one confirmation bar. Sometimes we talk about three, right? 3 days trading above a moving average or a certain level with the bar completely above the area that we're looking at. Right? You hear me talk about those things. So we're never trying to catch the exact bottom or exact top. We're just trying to catch the meat in the middle. And the same thing here. So we don't want to anticipate a breakdown into the MA50. We just want it to happen, and then we can catch it after it happens. Or this could just chop, and then we'll see. We'll have to wait for a breakout of this range. So today, once again, since we're opening pre-market right at the level, then we'll watch carefully, see if we break down. If not, well, TLT and VIX tell us it's maybe not. That there's a decent chance that we'll just bounce and move higher. So we'll just wait until we get a clear direction, keep our powder dry, keep our portfolios mostly neutral, maybe slightly bearish leaning, and then we'll wait for a high conviction area to start allocating our money. Okay, so that's it for this morning. Have a great Thursday, and I will see you at the market close.